So let's kind of see if we can conclude our financing decision discussion, right? So if the company has a very rosy outlook, more than usual, what will increased leverage do? It raises the sustainable growth rate and it increases earnings per share. If it's not rosy, increased equity does the exact same thing, but granted on a lower scale, right? So let's think about this. If we look at the graph we had earlier, right? Increased profitability, it doesn't matter whether it's stock or bonds, you will have increasing return on equity, right? So what's the difference? The difference is the magnitude of the difference in slope, right? So bonds will provide much higher changes in return on equity than using stock financing. So in the end, what do they refer to the tea leaves, right? What do we get from this, right? Managers, and I've already referenced this in a previous video, managers know more about a company's future than investors. If the market hears that a company is planning to issue new stock, should it conclude managers have a rosy outlook? So if the company is going to issue new stock, what does that tell you about what they think about the stock price? If they're issuing it, right, they think they're selling it, they think the stock price is going to go down. So is it any surprise that stock prices fall when companies say they're going to issue new stock? And of course, it works the exact opposite if they're repurchasing stock. So managers could use new equity, again, to send a message, right? If they think current equity is overpriced, they issue stock. We know that. They know. Everybody knows that. So that means that the stock is going to go down, right? So managers who think the true outlook is rosy, right? They think it's going to be a better world. They don't want to issue stock because we won't see it that way. I had mentioned this a little bit earlier. It's called the Pecking Order rule. And essentially it describes how management might go through this process. They're going to fund new projects with existing cash and profits before they decide to go outside to the marketplace. If they go outside, they're going to try to fund externally with debt, and they'll use equity only as a last resort. So what this means is companies want to maintain the ability to borrow. They want this flexibility. So let's talk a little bit finally about what drives management's decisions to begin with, right? Managers are human beings, right? They have a tendency to place themselves before shareholders, right? So they're looking after their private value at the expense of shareholder value. Aggressive debt financing can put the heat on them. That reduces, right, the extent of the value transfer possible without taking financial risk, right? So managers don't want to get in trouble, so they're going to tend to be much more conservative when it comes to borrowing. Again, this has to do with this idea, this process of, we talked about these 5 factors. How does that affect our business? For rapidly growing businesses, right, making financing subservient to operations as a source, of course, of value. What this means is that managers should put the financing question after the operations question, right? So this means, again, managers should tend to be more prudent than not when it comes to thinking about financing. We want them to be conservative. So a conservative leverage ratio with ample unused borrowing capacity is seen as being great. A modest dividend payout policy preserves cash, gives us some rainy day money. If the investment needs temporarily exceed funds, draw down your cash first and then use debt as a backstop. Debt's last. Don't issue debt if it jeopardizes financial flexibility. We should sell equity rather than jeopardize financial flexibility. And finally here, we want to constrain growth only as a last alternative, right? I can't conceive anyone sitting around saying, how can we constrain the growth of our company? What if you are a low growth company? The nice thing about a low growth company, not that it's nice, is that you have an easier time with financing decisions. If you're not growing, that means you have cash flow growing. So you have excess cash flows. Financial flexibility is not an issue. Market signaling is not an issue. So they use the company's healthy operating cash flow as a magnet to borrow and then actually use that money to repurchase shares. What are the benefits in the end to debt? The company will have increased tax shields if it's profitable. A share repurchase announcement is warmly greeted by the market. Stock price will go up. The higher debt will inject additional discipline to management incentives. So the last question, not that we've answered the first question, which is how much debt should we have, is, what lifespan should our debt have? As a general rule, you want to match the life of the asset to the life of the financing. So if you're borrowing or buying a car, has a lifespan, let's say 5 years to 7 years, you would never borrow money for 30 years to buy a car that's only going to last 5 years, and vice versa, right? So if the debt matures too soon, in the end, you may have to refinance. However, if it matures too late, you're not really managing your cash flows that well. Inflation also has an impact on this maturity issue. So frequently, if you think about a mortgage, right? When you first get a mortgage, almost without doubt, the payment is higher than you might be able to reasonably cover right now. Or in other words, it's tougher to make the mortgage payment in the beginning. But as time goes and as inflation rises, the value of the dollar goes down. But in addition, your paycheck goes up relative to inflation. So if your paycheck is increasing and the mortgage is staying the same, it becomes less and less a percentage of your cash flow. Plus those dollars that you're paying back 20, 25 years from now buy a lot less out there than they did in the beginning, right? So again, only if inflation is unexpected, though, does that true relationship hold that debtors gain at the expense of debt holders. Because if you're an investor and you think inflation is going to happen, what do you want? You expect to be compensated for the inflation that you expect. So interest rates change relative to how investors think inflation is going to occur. And again, these last several videos on financing, I agree, are a little confusing, right? Mostly because in most discussions on finance and making financial decisions, as I've mentioned several times here, we always get an answer. We don't have an answer here. In the end, there are too many variables that we need to consider to have a formula that would tell us how much money to borrow. So again, I hope you enjoyed the videos. I look forward to seeing you the next time.